Good evening, everybody. It's a nice spring evening around most of the country. Let's see. All right, this was the session I was supposed to have done last week, and I goofed up. But this is one of the most requested sessions. People are always wondering where do we come out of a bad trade? Where do we put our stop losses? So, a rhetorical question. What is the function of a stop loss? Most people are going to say that it's to protect your capital, so you're not in a situation where you're taking big losses. And that's probably mostly correct. The other mostly correct is to keep or maintain your mental control. And that's based on what happens when you're in a good position and then all of a sudden it goes slamming against you, or you just bought a position and it was looking great, and then all of a sudden it goes against you. What do you sit there and I say you? I put myself in this category because I know what the answer is. You sit there and think, "Oh man, I was doing so well. I hate to give up this." Becky, you might have to type in for BR to either click on the red X and come back in, or check his speakers, the volume on his speakers. Um, I forget what. Oh, so what happens when all of a sudden a trade goes against you? You're sitting there thinking, "Oh man, what should I do? Um, oh, what should and that's all mumbling and uh, hesitating to say. Most people um, sit there and say, "All right, I got to figure out how to do this trade," and then they forget about watching all their other trades. So first of all, it's protecting your capital, but more importantly is to get control back to your mental thinking and not being sitting there like a deer in headlights. And the third aspect is you have those funds out of a bad trade when you stopped out to now think clearly uh, of what to do with those funds. Sometimes it's a kicker signal in progress. You stop out right away and you go the other direction. So putting a stop loss in at the appropriate place is the process for the old adage, cutting your losses short, letting your profits run, but nobody ever tells you how to cut your losses short and let your profits run. With candlesticks, it's very simple. You can identify where you should not be in a trade. Now, here is the statistic that most people don't address. If you can expect 70% winners, and that's pretty much the amount that I have seen over the last 30 or 40 years, that 70% of the trades are going to be positive. Now, some of them aren't going to be any more than 0.3%. Others are going to be 300%. But that seems pretty good. But what most people forget is that 30% of your trades are going to be losers. Not because the trading system's bad or that you're analyzing anything bad. It's just pretty much statistically that prices move around enough that 30% of your trades aren't going to work. So what do we look for on a good trade? We're looking for expectations. That if we were buying on this day, where would we set our stop loss? It shouldn't come back through the open of that day because this is the candle that told us the bulls were taking control. And it was above the T line. Remember, the T line has a very simple statistical probability. You stay long as long as you don't see a sell signal and or a close below the T line. So if I'm buying and this was the day that told me the bulls are in control, I'm back out of this trade because it tells me it's not doing what we expected. It's going the opposite direction. It's not a good trade. Close it out. And that's part of the thing that that took me a while to really catch on to, because I was thinking every time I put on a trade, I'm going to make good money. When I finally realized that 1/3 of your trades aren't going to work, it now does not become an emotional problem. You just say, oh, that trade didn't work. Let's close it out and go find a good trade. So, rule of thumb. Whoops. I guess the rule of thumb ought to be where we can read it. You want to place stops at levels that prices should not logically be trading if you were in a bullish position. If this is your fry pan bottom and you're expecting a breakout, where should it not be trading? Probably shouldn't be trading back below the low and or the open of that previous day, because it should be going in this direction. Worst case scenario, it shouldn't be coming back through the T line. So are there going to be things that affect your price move? Definitely. There's probabilities of a trend or a trade working in the right direction. But then you got to put your stop at where the probabilities tell you this trade's not working. If you're in something like this and you're in the overbought area, just a common practice is if this is in a bullish uptrend, it shouldn't be coming back through the open of that previous day. That's where you put your safety stop. Now, I say this because through the years, when I've gone to jump in the pool, go grab a sandwich, go kick the cat, anything, the number of times I come back and say, oh, what the heck happened here? That if I had left and I had my safety stops in, I'm happily now, when I do that constantly, come back and say, man, I'm sure glad I got stopped out where I thought I should be stopped out. So, rule of thumb, if prices are in the overbought area, put your stop at the previous day's open or the previous day's low. And I say that on the basis that it only takes approximately 7 seconds to type in a stop loss order. And I kicked myself so many times saying, why didn't you just take 7 seconds and put a stop in? If it doesn't affect anything, no big deal. But when it slams through a price where it shouldn't be trading, the candlestick price traders have very simple logic. If you're in the overbought area, they shouldn't be trading back below the previous day's low. If the candle that told you that the bulls were in control, the Japanese rice traders make it very simple. It shouldn't close back below the halfway point of that candle that told you the bulls were in control, because if it closes back below the halfway point, the bears are still in control. Henry, two things can happen there. One, either you're putting your stops too close, or and two, Just because you got stopped out of a trade and it came back up, you got to ask yourself, is this still doing what I expected it to be doing when I bought it the first time? You can always buy it back. I would say there's a good 20% of the time where I get stopped out of a trade and then get back in because it went down and then it came back up again and came back up above the T line, not doing anything that told me that the trend was over, and I buy back in. So I've got a statement that says if a price move is up 10 points and I only get 8 points of it, but every time I'm in, I know I'm in the right direction, that's fine with me. That means I got stopped out a few times or once or twice and got back in. Uh, if I buy during the day, do I put a stop loss at the for the rest of the day of for the rest of the day and tomorrow to catch lower trading in the morning? Carrie, I don't know what you're asking, but let me go through this. We'll see some logical places where you put your stop loss. Do you limit orders or on close? Is that what it is with a market order? No, I use a stop order. You can use condition orders, but that's usually for options, where you say if the stock comes back down through 50, close my calls. Oh, depends on how often you're looking at the trade, Gary. If you're sitting trading most of the day, you're probably doing it as a day order. Then the next day, if it opens positive, you might move your stop up. So let me see if I hit a few of these as we go through. So here's logic. If this is our morning star signal, close above the T line, and you buy in the next day, what was the candle that told you the bulls are taking control? This one here. When it came back through the halfway point of this candle, it's not doing what it's supposed to be doing. First of all, the doji rule says it's not moving or it's moving in the direction that they expect after a doji. So you have your stop right here or the T line. Because what is your expectation? It should be moving in this direction. It shouldn't be coming back here. Now, it might be coming back here because they announced something or the market turns south. Doesn't matter why it's coming back here. You're seeing that everybody's selling again, close out the position. Would you repeat the stop orders, please? No, you don't use a stop limit order. A stop limit order says if this stock comes back down through 50, I want to sell it at 50. Well, the next trade when it hits 50 might be 49.98. They can't sell you out at 50. And it keeps right on going because they couldn't sell you at 50. If it hits 50, you want to close out the trade. Whether the next trade is 49.98 or 49.95, close it out. What is the buy signal candle? What is the buy signal candle? The RW, I don't know what you're asking. There was a morning star signal with a bullish confirmation of a doji. That's your buy signal. Next day it opened positive. Yeah, that's your buy signal. RW, have you read high profit candlestick patterns? That has the 12 major signals and the patterns in there. Gary, yes, use trailing stops when we're in an overbought condition. I'll show you that. So if you're trading a pattern and overbought, then the stop goes at open or low of the previous day, But if you were trading a signal, then the stop is at the halfway point. Yes, this is just starting. This is starting your next uptrend. What's expected when you see a candlestick buy signal in the oversold area? More upside. And if this is the candle that told you the bulls are in control, it shouldn't come back down through that halfway point. Now, it shouldn't close below the halfway point. But if you could see that it was trading off because the market was selling off or they announced something, you close it out when it comes down through this level. If you're waiting to the end of the day, it shouldn't even trade back below the open of that candle, because that's pretty much telling you there's no bulls in this trade. Get out of the trade and go on to something else. So the first thing you ask yourself when you get into a trade is, why are you buying? Because you have expectations of what that trade should be doing based upon candlestick signals. Uh, Tom, the second book I wrote was High Profit Candlestick Patterns. That's the meaty book. That's got all the meat in it. Now, the first book I wrote, which was published through Wiley and Sons, is Profitable Candlestick Trading. And I usually tell people start with the high profit candlestick patterns, because that's going to go more deep into the 12 major signals and the patterns that work successfully. Then the second one is book to get is Candlestick Profits, Eliminating Emotions, because the whole process of investing is not only knowing what to be looking for as far as your strategies or your signals and patterns, but if you don't have your emotions controlled, that's what causes good candlestick signals and patterns, because human emotions are what cause those signals, which is what we want to take advantage of, because usually those emotions are wrong. And then if you want to go back for a review, the first book I wrote, High or Profitable Candlestick Trading with through Wiley and Son, you go back and get kind of a more general overall uh, analysis of why candlesticks work. What is OCO? One cancels other. All right. One cancels other. One cancels, or order cancels order. Conditional orders. All right. All I can tell you is, if you're buying for a reason. And that should be, in the case of candlestick analysis, you've got a strong buy signal and you've got confirming indicators that are confirming, which is what confirming indicators do. Then, if it doesn't do what it's supposed to be doing, you should already have picked out a level or identified a level that told you this is not going in the right direction. Close it out. So once you have expectations of what a price should do, and it confirms, you want to see the confirmation. So if you were looking at Netflix and it opened positive, confirming that left-right combo and trading back up above the 200 and the T line, that's a good place to be buying, because what is our expectation? We're heading back up again. So where would be a likely good place to put a stop? If I was buying up here, I'd immediately put a safety stop at where it opened, because logic says if it comes up and then comes back down through where it opened, it's coming back down through the 200, the T line, and it's not going in the direction it should be uh, going. Yes, CC. I think Becky threw the link in. We've got them on our website, and they're a lot cheaper than if you go to Amazon or someplace. All right, so it shouldn't come back down through where it opened. If I was buying this one, because I've got a bullish Harami, stochastic coming out of the oversold area, now it's open positive after a doji. It's got all the makings of a high probability bullish trade. Where should it not trade? One, it shouldn't come back down through the open, and two, it shouldn't come back down through the T line. That's not what we expect for it to what we were expecting it to do. That's part of that 30% probability that that trade didn't work. Close it out and move on to something else. Now, that is an emotional grind because what do we do when we sit here and analyze? We got a good trade. I'm doing good. I bought it. It's moving up. What do we hate to see? That it turned around. It affects our ego because we're thinking, now, what the heck? Or why me? How come whenever I buy something and immediately goes and turns around, it's not you? It's that 30% probability. You just tell yourself, that didn't work. Let's move on to something else. Okay, but did you get stopped out? I'll get to those. Um, and I'll get to eyes right now because this is what, with this type of signal, what did we want to see for confirmation? If you bought yesterday, what did we need to see today? You need to see it trade positive. So where was the stop on this one, Jake? Didn't I just say that if you bought on positive trading, your stop would be back at where it opened? Because if it comes back down through there, what color is your candle turning? Going from red or from green. When it comes back down through the open, and now you've got a tail to the upside and a red candle. What's that telling you? The bears are still there. Close it out. Now, are you going to get stopped out sometimes and it comes down and then all of a sudden it comes back up? Definitely. But if it comes back up and doing what you expect it to be doing, you buy it back because that's the whole point of uh, why you were buying in the first place. So on eyes, I would have stopped out if I had bought this one yesterday, which I didn't. I would have stopped out as soon as it came back down to the T line and yesterday's open. Because what did that tell me about the direction? They weren't going in the direction we expected. Close it out. Now, I'll reiterate, it's hard to close out a position because it looked so good and the probabilities were in our favor that it should be going in this direction. Unfortunately, it didn't. And we're thinking to ourselves, and again, this is me thinking to myself, what the heck is wrong with me? Why is every trade that I buy all of a sudden turn around and go the other way, blah, blah, blah. It shouldn't be going in this direction. Close it out. And when you close it out, you've got three things going for you. One, you've got your mental control back in hand. You've cut your losses short, and you've got that cash back in your account to go find another trade to, to go and find a good trade. Exactly. Yeah. Which one on that one? On eyes? Have not broke the downtrend. Correct. That's what you needed to see positive trading. If it hits your mental stop loss target in the first 15 minutes of the market opening, do you act or you wait? If it's a real quick knee-jerk reaction in the first few minutes, you got to think, all right, somebody was taking profits, somebody was closing out the trade. you wait to see, give it a few more minutes. And if they're still selling, get out. If they stops and turns around, yeah, you wait to see what happens. Uh, it would probably have to come back up through the open of yesterday, or I'm sorry, the close of yesterday. That would tell me whatever selling is over and the bulls are back in control. All right, so if you see something like this and it opens positive and starts trading like this, what type of candle or what type of signal do you have going on? Opens here, and you got a big green candle, a kicker signal. So what do we want to be doing on a kicker signal? Definitely be buying. Where does the kicker signal not become a kicker signal? If they come back down through the open. If it comes up here and comes back down through the open, close it out or set your stop right there. VG, wait till we get to live charts. Uh, it is a red candle now, but if it opened here and started trading positive, a kicker signal is where they open here and close down here. You have a red candle. The next day, they gap it up. Look where it opened on this day. It opened right here. And it started trading positive. What color was that candle as it was trading positive? That was a green candle. That's your kicker signal. So if this had stayed up here, you would have had a red candle, then a gap up above the previous day's open, and a green candle. That's your strongest reversal signal. Well, that's a good signal. Except in this case, when they brought it back down through the open, who was now in control? The Bears were back in control. You want to close out that position again. VITL was a good 10-minute stop loss. All right. Yeah, sometimes when you get up this high, you can go to your 10-minute chart. If I see something like this, look at our Morningstar signal, and they gap it up, that's where it opened and started trading positive. Where do we expect that trade to go? Further up. When it came back down through the open, what was that telling us? The bulls took control at the open and took it up. As soon as they came back down through the open, the bears were back in control, close it out. That's a bad trade. If I'm expecting a pattern, a fry pan bottom, and I bought here, which I usually wouldn't, I wait to see it traded. All right, but let's say I bought here and it immediately started coming back down through there. What that tell us about our expectation of this fry pan bottom? It's not working. Close out the trade immediately. So if you've got the mindset to tell yourself that if I get into a trade, there's a 30% chance that it won't work, but I'm buying the trade because the probabilities are pretty much in my favor, it's going to move in the direction that we expect it to. I think I've goofed up on this one. Yeah, I lost somewhere. I'll have to find the other half of that chart. So here's another one. When this opened positive and started trading positive, what pattern were we looking at? John, it doesn't even matter. You don't care who's selling or why they're selling. All we're identifying is, are they buying or selling? Pretty much a J hook pattern. Best friend, not best friend, but a bobble breakout. and then they gap it up, what should we be expecting? A very strong price move. So if I was buying up here, what are we expecting out of this pattern? More upside. Where would we have our stop set? At the open, because logic says if it comes back down through there, this is where the bulls told us they were in control. The bears are back in control. You close out the position. Yeah, I wouldn't call it a scoop. I'd call it more of a J hook, bobble breakout. And you also, yes, got the T line crunch in there. So everything we look at is logic. If this is a pattern, a fry pan bottom, here's our expectations. If this told us that the breakout had occurred, where should they not be trading? Back below the open of that candle that told us the bulls were in control. So basically, when we see a pattern or a signal, we should get out when it trades where it's not supposed to. Well, isn't that what we have been repeating? Yes. Do we need to wait for confirmation to close? Not necessarily. If this is supposed to be a pattern breakout, it should be going in this direction. It shouldn't be coming back through here. If it is, you close it out, whether it's 20 minutes into the day or 3 hours into the day. On Axel, what if on the shooting star candle it became red but never traded below the previous day's close? Do you still keep the stock? Well, if it closed right here above the previous day's close, then you've got your choice, knowing that it has to open positive to stay in it. If it opens lower, it's confirming that signal. You close it out then. But if you had bought up here and it came back down to the open, what was the message you were being given? The bulls weren't in control. It doesn't matter whether it closed here, 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 or here. When it came back down through the open, it's telling you right away the bears are taking control. Get out of the trade. It doesn't matter where it closed after that. Now, if it closed right there, yes, now you'd be out of the trade, but now you can see whether you want to buy back in the next day or see if it sold off the next day. So, yeah, we don't need to be overanalyzing this stuff. If this is a fry pan bottom type breakout on overstock and it's trading up like this, it's doing exactly what we would expect coming out of a fry pan bottom breaking out. But where would it tell us the bears are back in control? Or if the bulls aren't in control? They came back down through the open. You close it out. You can always buy it back when there's signs of the bulls taking control again. But that should tell you right away that if this was where they opened it and the bulls were in control, when they came back down through that open, the bulls weren't in control anymore. There's the other half of that chart. So if we were buying here, our stop would have been the halfway point of this candle or the T line, because it should have been going in this direction, not rolling over into this direction. If I bought on this day and it came up, said, I hit the first resistance level, but it's got a nice pattern to it, where's the logical place to put your stop? At the previous, or at that open. Comes down through there, you want to close out the trade. Simple doji rule. Wouldn't think there's any problem, but you put your safety stop here at the low of the doji, which is also the T line, Because logic says if they have enough strength to come back down through that level, this is acting as a resistance level. They didn't break out, close out the trade. And this is why you stop out of a trade. If you put your stop right there the night before and said, all right, the trade's back down through this level, I want to close out the trade. Well, when they opened it, they closed you out. Now, I know there's people sitting there thinking, well, what if it comes right back up? Human nature is if you're in an uptrend and they gap it down below the previous day's open, the probabilities are that the bulls aren't there. You want to be out of that trade. Now, every time I saw something like this, I would sit there and say, oh man, if they would just take it up one more time and let me out. But I discovered if you close out the trade, you're not thinking about it all day long, wondering what to do. You've got the money back in your pocket and you've got your mental control to tell you what to do next. Why is that candle's green? Oh, because it opened here and closed above where it opened. What time frame do you monitor your daily charts before drop down to the 10 and 5-minute charts? It's not any time frame. But if I was way too far away from the T line, I would see what it's doing. Then I'd flip to my 10-minute chart to see what it's doing at that on the 10-minute chart. So if this is our expectation, a J-hook pattern, where would our safety stop be? At the T line or at the low of that doji? Because if it opened positive, what's our doji rule? They're taking it this way. If they open it lower and take it back down through that doji, I'm thinking CC. Hold on. It shouldn't be going in this direction. Stop yourself out. Put a safety stop. If it opened lower and you didn't stop out right there, then you put a safety stop below the T line. Because what does our doji rule say? It's going to move in the direction how they open at the doji. If you're thinking maybe it will bounce off the T line and head back up, fine. But if you had your stop just below the T line, told you they weren't stopping at the T line. On this one, it doesn't matter. Remember, the color of the candle is based upon where it opens and where it closes, not where it trades from the previous day. So this one opened here, traded down apparently, and closed back up above where it opened. That gives you a lot more information, especially during a trend or the lack of a trend. So it doesn't matter what the color of the candle is, or it doesn't matter if this is a green candle when it traded lower. It's just telling you where it closed compared to where it opened. In all the examples you showed, if you were to short a stock, once it shows the bulls are not in control, you would have profited. Or do we see that as too aggressive? Just because an uptrending stock, I mean, nah, some of these so just because you stopped out here didn't mean that was time to go short, because you can see it came right back up again. So just because something shows that it's not a good buy doesn't necessarily mean it's a good short. Now, I'll emphasize the fact that you've got 9,500 trading entities out there. Just because one isn't working doesn't mean it's in a downtrend. Just means it's not in an uptrend. There's same simple scans to help you find the best downtrending uh, situations. So this is why you want to know your 12 major signals. If you were short, where would you have stopped out? If they gap it up above the previous day's open, you want to be out immediately. Because what's it in the process of doing? Producing a bullish kicker signal, and you definitely do not want to be short if you're seeing a bullish kicker signal forming. All right, so if you were buying this one on this day, you immediately put your stop right here. Or if you saw it trade back to that level, you stop out of that trade. Because what's our expectation? A J-hook pattern with a doji sandwich opening positive, it should be going in this direction with a high degree of probability. But remember, the word probability does not mean guarantee. There's going to be trades that don't work, close them out immediately. Oh, this is a red candle. So this one opened positive. There's our J-hook pattern setting up off the 50. Gapped up, started trading positive. In a case like this, if I'd bought this, I'm stopping out when it comes back down through the previous day's open, because what's it creating? A red candle, and it's telling me the bulls aren't there. Close it back out. Right here at the previous day's open, look at our doji sandwich. What do we expect from a doji sandwich? More upside. What type of pattern was it setting up? A J-hook pattern. So it opened positive. What was our expectation? It should be trading higher. Well, if it started trading off, I'm immediately setting my stop at the previous day's open. Maybe it could come back down here and then turn around and come back up and do what we expect it to be doing, but it shouldn't be coming back down through that previous day's open. That previous day's open is just an indication that the selling is too strong for this to be a bullish pattern anymore. Close it out. Same thing here. Here's our fry pan bottom. If I was buying on this day because it looked like it was breaking out and did a doji, where do I set my stop? At the low of the doji the next day. Because what's our trading rule on a doji? It's going to move in the direction of it's going to move in the direction of how they open it the next day. Well, they open it. If they come back down through the low of that doji, what that doji trading lower tell us? That this was acting as a resistance versus a breakout. No, I wouldn't wait to the end of the day. Remember, if you're in an uptrend, there should not be enough strength of the sellers to take it back down through the previous day's open. Maybe I would have closed it if it closed more than halfway down that candle at the end of the day. I would have closed it out during the day if it came back down through the open of that candle. That's too much selling strength to say that uh, the bulls are still there. So this is why you want to know what your expectations are from a pattern and knowing what the signals are telling you. The doji rule is very simple at a breakout level. If it opens positive, it's going to move in the direction how they open it. If it opens negative, it's going to move in the direction how they open it. And if they open it negative, what's that tell you about this level? They're not breaking out, close out the trade. So setting a stop is very simple. When you're analyzing a trade, you're analyzing why you're buying it, whether your entry is being confirmed, and once it's moved like it should, where should it not trade back through? Now, the complacency that I ran into for years was I knew that every time I put on a trade, the probabilities were greatly in my favor that it was going to trade like I expected it to. The probabilities were that it was going to trade in that direction. But when I started realizing that not every trade's going to work, the whole process of closing out a bad trade quickly and moving on to something else is what enhances your returns dramatically because you're getting out of those bad trades and moving your money to something else that has better prospects for making you money. Lou, yes, all these sessions are recorded. No, Mike, just simple logic. If it comes down through the open of the previous day, the bulls are not there. You don't need to fudge by 5 cents, 10 cents, whatever you want to. The message is the bulls are not there. Close the trade. Do you have this seminar on a PDF? Well, I have the PowerPoint, and we have the, yeah, it's being taped or being recorded. Yeah, so if you registered for tonight, you'll get the recording. Bobby, I use my my trading universe is stocks greater than 5 and trading more than an average of 200,000 shares a day. I use 200,000 shares a day because I don't want to sit around waiting for a trade to be executed. When I put in a sell order, I want it sold so I can move on to the next one. I use stocks greater than 5 because most brokerage firms will not margin a stock less than $5. And every time I put on a trade, I want to get as much leverage as possible because I know the probabilities are in my favor. So I want to be able to margin it if I want to go that route. Um, to add to Mike's comments, do you always use the open or could you build in a slight profit? That's up to you. If you see something, I don't know which one. If you see something that had traded up and then it was coming back down and it just seems to be dropping, and it might be because the market has turned and it's coming back down toward the open or even toward the point where you bought it, you might stop out at those levels because from what you can analyze with it coming back down toward the lower end of the trading range, that the bulls aren't as strong as you thought. Worst case scenario, you stop out and then it turns around and it starts back up. You flip to your 10-minute chart and say, all right, are they buying again? I can always buy back in. Lee, I don't use stops for my options. I'm usually sitting here watching the trades, and the stops are based upon what the underlying stock price is doing. Okay, so what is our biggest fear about placing a stop loss? Our biggest fear is getting picked off. Man, they stopped me out, and then it turned around and headed back up. Well, before, without being able to analyze what normally happens with uh, human nature, I'd say, they're not going to trick me again. They being I don't know who, but they weren't going to trick me and get me back in so they could turn around again and take some more profits from me. But now I know what patterns to look for. But if I get stopped out, let's say I put my stop right there, or maybe I even put my stop right there, I can always buy back when I see the next pattern set up. So I'm not trying to fight the proverbial they that knows what I'm doing and they're doing everything possible to make me lose money. I'm watching to see what human nature does. To any dollar range, and I only use $5 and up. If you want to do if you're like trading stocks at $1 to $5, you set your universe for stocks trading between $1 and $5. But I try to keep my volume up so that when I make a decision to close, I'm not sitting around for 15, 20 minutes seeing if they can get my full order executed, or having to, I want to put my stock or my price in at market and they hit it right there at the market, not having to sit there and wait for it. Does all these stop strategies work on the end of day trading? Does all these stop strategies work on end of day trading? No. During the day, you know. So if I've got a good strong move and I see it gap down, why would I put a safety stop right here? Look how far away we are from the T line. Look where we are on our stochastics. So where's my trailing stop? At the previous day's open. Don't want to see it trade back below there. Because if it does, where do you think our next target's going to be? Back to the T line. If I see something starting to roll over, and it did a doji but closed up above the T line, where's a logical place to put a stop? Back at the low of that doji. Because if this was still in an uptrend doing a J hook, this should open positive and trade positive. It shouldn't trade back below the T line and the low of the doji. That's a good place to put, a logical place to put your stop. So this is what we call observe the obvious. If this was our buy signal, this is where we sold out because it didn't do what it was supposed to, stay up above the T line. If this is our buy signal, hammer, gap up, trading positive, where should it be going based upon that signal? This direction. It shouldn't be coming back down through the previous, below the open. That's where you close it out. Because as soon as it comes back down through the open, this candle starts turning red. It's gone from green to red, and that immediately tells you the sellers are back in control. Diane, that used to be. What happens now is if you're using Thinkorswim, Schwab, E-Trade, and you're putting a stop in at $50, it's sitting there on their system, not on the market system, which means it's on their system that as soon as the price on the market comes back down through 50, your electronic trade kicks in, so nobody, the market makers can't see it out there. So the old days where they could see, or the market makers could see where all the stops were and they could run the stops, electronic trading has kind of eliminated that. The difference between a stop and a stop limit. A stop limit says if this stock trades up, if it comes back down through 50, I want to sell it as soon as it hits 50, and I want to sell it at 50. You're putting a limit in there versus a stop that says if this comes back down through 50, I want to sell it. Well, if the next trade is at 49.98, you've sold it. If you put a stop limit in that you said, I want to sell this only at 50 if it hits 50, and the next trade's at 49.98, they can't sell you out at 50 because it's trading at 49.98. So it can come all the way down because you wanted to get out at 50 and only at 50, you still own that stock. So the whole point of getting out of this trade was if it was coming in this direction, you want to close it out. You don't, it doesn't matter whether you got out at 50 or 49.96, 49.92, you just wanted to be out of the trade. It wasn't a trade you wanted to be in anymore. So simple stop losses. Remember our statistics on a inverted hammer signal. That if it opens positive, the probabilities are 95% or greater that it's going to go positive. So where's the logical stop loss spot? At the bottom of that inverted hammer, because it should be going in this direction. If it comes back down through there, it's not working. Close it out immediately. Overbought area is when your stochastics are up above 80. Oversold is when your stochastics are below 20. Does the bid-ask spread, when especially large, play any factor in fudging your decision to buy or sell when the price is near decision price? Yes. First of all, if the bid-ask spread is large, that's an immediate indication there's not a lot of volume in that stock. So you want to check to see what your volume is. So if I'm looking at a stock that's bidding 50 and they're asking 50, 60, well, I immediately look at the volume. If it only trades 120,000 shares a day, that's maybe a little bit difficult to get in and out of. So if I wanted to buy that, I'd put a bid in at 50-30, right in the middle. And if after 5-7 minutes or so they haven't filled it, maybe I'll move it up to 50-40. And if in the next 5 minutes they haven't filled it, then I'm going to look at it and say, all right, is this a stock that has big upside potential that maybe I just go ahead and buy it, or should I pass and go on to something else? Oh, Brad, what do we got going on here? Oh, you're typing. All right, good. My stochastics are 12-3-3. That's because I'm a swing trader. Most of my trades last anywhere from 2 to 10 trading days. And it was a very sophisticated process. Somewhere around 30 years ago, I was sitting in my office, which at that point was in the living room, and they had just started putting candlestick charts on the computer. So I would go back through charts and I would see where they peaked out and where they bottomed out. And then I tweaked the stochastics. At that time, 14.55 seemed to be the standard, but that was a little bit slow. So I went to 14.31, 12.55, 12.34, and finally came up with 12.33, just to see where we were if we were in the overbought or oversold area. Let's see, did I answer the question? Yes, so 12.33 is what I use. Under the doji rule, if it opens against your position, do you close out immediately or give 90 seconds? If I'm in a situation like this, and let's say I bought and it opened lower the next day, and we're still just coming up out of the overbought or oversold area, I'm going to give it time just to see, because we're still in an uptrend. If I'm up in an overbought condition and I'm away from the T line and it opens lower after a doji, I close it out immediately because it's probably coming back to test the T line. So anytime I make a decision or put on a trade, I know what it should be doing and what it shouldn't be doing. So when I look at that trade, I want to know what the trend is doing. Why did we analyze where it should be going? Was it a bullish signal, a bullish pattern, a pattern breakout? And then if we buy it based upon those expectations, what should be done when something alters that trend? We just pick a spot that says, all right, it's not doing what we expect it to be doing. So every time we put a stop in, it's not so much to protect yourself from a big financial loss, but it's to close out a bad trade, keep your mental process clear, and move on to something else. Is there a similar rule for kicker as there is for inverted hammer, or does it trade below the open of the prior day? The kicker signal is your strongest individual candlestick signal. If it gaps up above the previous day's open and starts trading positive, the gap up is already built into the signal. And if it starts trading positive, you've probably already got a good indication that the bulls are dramatically in control and the probabilities are pretty strong you're going to move positive. Again, the word probabilities. So if it started moving positive, but then came back down through the open, what's that done to your kicker signal? It's eliminated the kicker signal. If it closed below the open, you close it out because the bulls didn't take control. Okay, so you don't have to use formulas. You don't have to know percentages. All you have to use is common sense analysis, that you're analyzing why you're buying that situation, what your entry confirmation is, and then what this trade should not do to make that a bad trade. And this is all based upon one simple parameter, human nature. All right, so with that, let me see if I can go to live charts. Almost had it. All right, so this, let me go backwards first. That's not a... So we could see what happened here in the market indexes. There was the shooting star in the Dow. Lee, that's, yeah, so if you just listen to what Yogi Berra said about golf, that 90% of that game is half mental, that's pretty much trading. Not only do you have to recognize when your trades are working, but you have to know how to keep your mental control to know exactly what to do with those trades. If you have a strong kicker signal and the stock is trading below the T line, would you buy? Yes. The number one aspect of any candlestick signal is the signal. Guess I said that. The aspect of any candlestick chart is, number one, the signal. Then everything else is just confirming indicators. So a kicker signal, what you want to see in most buy signals is you want to see a candlestick buy signal in the oversold condition. The Japanese rice traders say the probabilities are pretty strong. You've got a bullish reversal. Same scenario on the upside. If you see a candlestick sell signal in the overbought condition, you probably got a downtrend starting. If you see a candlestick buy signal in the overbought condition, it doesn't mean anything. If you see a candlestick sell signal in the oversold condition, it doesn't mean anything. So if you see a candlestick buy signal in the oversold condition, that's good confirmation on all the major signals. except for the kicker signal. The kicker signal can happen anywhere in a trend. If you get a kicker signal in the overbought condition, that means there's going to be more upside. No, so Jake, it doesn't have to be in the oversold area. Let me go to one here real quick just to kind of illustrate that point. This is Oracle a while back. There's a kicker signal. Wasn't in the oversold area, but it was at the lower end of the scale. Started the uptrend. There's your kicker signal up here in the overbought area. I told you there was still more upside. So the kicker signal does not have to comply with where it occurs as far as stochastics. Can brokerage firms borrow your shares if they run out of the ones they have? And if so, how do you prevent this? You don't. When you sign a margin agreement, part of that margin agreement is saying that if they need to come borrow your stock to lend to somebody so they can short it, they can do so. Doesn't mean you can't get it back. If you the next day sell that stock that they borrowed, they know they have to go out and borrow it from somebody else to put in your account. So you don't even have to worry about it. Does it matter if a kicker happens on an announcement of earnings? Does that add strength? No, Jake, it doesn't matter what caused the signal. Remember, you can have a fantastic earnings report and the stock drops stock. So the signal is the affirmation of what investors think should be happening after that announcement. So if it's a kicker signal, it means they really like it. It's got very strong bullish implications. In the overbought area, what if the bullish kicker type signal with the tails or on both candles, would you be more cautious? Yes. A true kicker signal shouldn't have a tail down here. But if it does, it doesn't really matter. It's still a kicker signal. The true kicker signal is like this, where they open it and immediately start trading positive. But even if it has a tail, the fact that they gapped it up, there's some immediate profit taken and it took it up. It still told you there's a drastic change of investor sentiment. Marshall, that is the first one I have. After we go through some of the ones that we're already in, let me go through those real quick. Nucor, you can see the fry pan bottom. You can see the fact that they did a bullish harami today above the T line. Get ready for your J hook pattern for the next price move. Hecla, when it broke out, all you have to do here is stay long as it stays above the T line. LBRT, same scenario. When it broke out, you just stay long as it stays above the T line. ACAD backed off a little bit today, but you can see what type of pattern is setting up. Kind of a fry pan bottom. You could still be buying this one on positive trading. Bill, hang on to your individual ones until I tell Rick to do the double line. Nimrod broke out and now is in the process of trying to do a J-hook pattern. Here's another one where you just stay long, hoping that we're going to have a J-hook pattern, but maybe more inclined that it's going to be a 45 degree. It's still, you stay long with it as long as it stays above the T line. Now the ones that we're making big profits on, excuse me, the short situations. So here's your 2+2 analysis. failed at the 50, closed below the T line. Did a bearish engulfing, failed at the T line. Did a double doji sandwich, rounding top. Even though we were toward the oversold area, that was a strong sell. That's why we shorted this one, even though we were in an oversold area, because there's still a lot of force to the downside on this one. AMTX, same scenario. Where do you think the next likely target was going to be when it failed here? Wave 1, wave 2, wave 3 was likely going to take you down to the 200-day moving average, which is what we saw in Riot. Wave 1, wave 2, bearish left-right combo, gap down to the target. And Myra probably aiming for that same target also. So again, this isn't rocket science. This is what we call a blue ice failure. They came down, they fell through the ice, they came up to find where they fell through. They couldn't find it, they drowned. Where are they going? To the bottom of the pond, which is your next support level. Logitech, we had a good profit in because there's your bearish kicker signal, there's your bearish doji sandwich. But getting down here, it was kind of holding up. We'll still re-short it if it opens lower, because where's your likely target? Down to the 200-day moving average. So making lots of money on the shorts right now. And how long do you hold on to these? You stay short until you see a candlestick buy signal and a close, or at least now at this point, a candlestick buy signal. So the reason we're short is very simple logic. When you saw the NASDAQ selling off, look at your bearish doji sandwich. It's still in a downtrend. Now today's doji gave us that trend analysis. It's likely going to move in the direction of how they open after the doji. So if they start trading positive tomorrow, you probably cover some of your short positions because it's likely to bounce back up toward the 50. I'm sorry, the T line. Do you directly short shares? Both. Just SP just depends on which accounts I'm trading in. Can you go through the logic on Nimrod? All right. Big breakout. Huge move. Now here's another case where how do you take profits if you were buying down here? Because up here you that far away from the T line, that big a move. What do you think most traders are going to do? They're going to start taking profits. So how do you know when it's taking profits versus way down here somewhere? You flip to your 10-minute chart, and as soon as you see a sell signal and a close back below the 10-minute T line, you take profits. Why? Because the daily chart told you you're way too far away from the T line. Get ready to take profits. Yes, you can still short the NASDAQ if it opens lower and trades lower tomorrow. Stay short till they take your shorts away. There you go. Lots of that lately, Henry. Eventually, it may be climatic reversal, but it will give the candlestick signal then. Yeah, so you stay short until you see a definite reversal signal. Milton, is that a symbol that we're waiting to do once we tell Rick to do the double line? So here's another one. Just stay short until you see a buy signal. Apple. Notice that it moved up today, but what was the magnitude of its strength? Indecisive. Nothing major. So you wouldn't be going long, and you wouldn't go long on Apple until it closes above the T line. Amazon. If you're short, you stay short. NVIDIA. Stay short. Where's the logical target? Right. Everybody's waiting to see if it will support on the on the 200-day moving average. Tesla. Notice how it could never get back up above the T line after it did your kind of your wedge breakdown with a best friend signal, and now it's not even supporting at the 200 yet. Doug, didn't we do this one earlier today? The SPY may have done a bullish harami, but not in the oversold area. So it might be waffling in between the T line and the 50. Okay, I think we've got most of the ones that we're in. Oh, I did close out TDC short because you could see what was happening. A bullish engulfing, sold off, didn't confirm. Now a bullish harami, all this occurring in the oversold area, that would give you good indication that that's kind of where they're supporting. And what else would give you an indication that's where they might be supporting? Well, look how far away you are from the T line, number one. Number two, where did they support before? Right back over here in this same areas. So the probabilities are starting to go against you as far as being short. When setting a trailing stop, how do you determine the amount? Bob, no price. Let me figure out something. If I'm long and I'm up in the overbought area and it closes here, opens the next day here, I've got my stop now moved up here. Opened here, closed up, I now have my stop moved up here because logic says if they can come back down through that level in the overbought area, that's where I set my stop. Why did I get in? Oh, I was short this one from the best friend gap down. And it came right down to the support level. I was watching to see if it was going to break that and head for the 200, but it seems to be supporting here. Still in ET. Yep. Let's see. Yeah, these are the ones I was going to. What type of pattern can we see in ET? There's your classic fry pan bottom J-hook pattern. IGT, this is 2+2 analysis. There's your fry pan bottom. There's your J-hook pattern. And what evidence can we, can someone please draw the double line? Georgette, when I tell Rick to do the double line, that means then you can put in your individual stock requests. But we try to eliminate that before we say, I tell Rick to do the double line so that we can do the ones that I'm trying to illustrate. So when I tell Rick to do the double line, that means if you have a stock that you want to have analyzed, you can type it in. For stop loss, if the previous day's candle is relatively big, you could use the halfway point, yes. And if it's moved too far away from the T line, yeah, you might just even pick the first sell signal. I think what Bob meant, and I had the same question, is not the stops you set manually for the day, but the trailing stop that keeps following the price. Well, that's what you want to set manually every day. The price or the market doesn't give a hoot where you bought. What we're analyzing is when are the bulls in control and when are the bulls not in control. So it's not because it's moved back 3%, 6%, 12%. It's at a point that tells you that trend has changed. Yeah, so I would guess you'd call it a mechanical trailing stop. Okay, this is ITG. You can see the fry pan bottom. You can see the J-hook pattern that's supported right on the 50. You can see the kicker signal. Notice it opened here, closed here. Then they gapped it up, went this way. Then you can see the doji sandwich at the breakout level. So these are all things that you can add up to produce additional confirmation the bulls are in control. So more than likely, let's see if I can make this smaller yet. Oh, pshaw. It's even looked like it's broken out. I just say it looked like. Let's draw a line just to make sure. Oops, now I got too many lines. So it looks like it's broken out through that level, which would imply that if this was one wave, make it even smaller yet. Wave 1, wave 2, wave 3 could be the same magnitude as wave 1. ET, more of a classic pattern where you've got the fry pan bottom, J-hook pattern setting up. So if this broke out through this level, what's our price move? Well, here's wave 1. Wave 3 should be up here in this range someplace. Oh, I don't even know how to answer that, DD. I don't know what you would use as far as a mechanical stop because I've never used a mechanical stop because of that philosophy that the market doesn't give a hoot where you bought and you're not stopping out because it's moved a certain percentage. You're stopping out because it's told you that there's been a reversal in the trend. And a 3% pullback may not be a reversal. A 6% pullback may not be a reversal. Might just be the normal oscillation. Okay, now what was I doing? Oh, BTRS, there's your fry pan bottom. Where did it break out? Right there. What did it do today at the 200? Didn't seem to resist. Where do you think the next target is? Possibly coming up to fill this gap. CHCI, nice fry pan bottom. So the difference between buying a signal is you're trying to buy signals in the oversold condition. You're buying patterns when they're probably in the overbought condition breaking out. Here is SI. SI has a simple trading rule, the doji rule. If it opens positive tomorrow, you can be buying because it's going to move in the direction of how they open after a doji. Now, if it opens positive and starts trading positive, where do you set your stop? Right here, because logic says if it opens up, trades up, and comes back down through that level, you want to be back out of that trade. This is great. AMC, I know a lot of people in the trading room were, let's say a few people in the trading room were trading it today. Another double bottom type setup, broke out through this level, probably coming back up. Yeah, it almost tested that level today. In these type of whipsaw markets, that's why utilizing the signals or the patterns are much more beneficial because a pattern has investor buildup in it. So it's not going to be immediately affected by the overall market trend itself. So as you can see on some of these, where the market had been trading off, it was still trading up. The pattern was telling you it was overriding. Is the level you are talking about yesterday open or yesterday's close? It doesn't matter, Jake. How much different is yesterday's open and yesterday's close? If it came back down through any of this level, it's so close, it's telling you it's going in the wrong direction. That's a kicker signal. I think who pointed this one out today? Marshall, is this yours? Notice where the gap occurred. Open here, closed here. A kicker signal is when they open it at or above the previous day's open and goes the opposite direction. To be specific, are you talking about the close? DD, I don't know about being specific. Are we still talking about SI? Does it matter? All it really tells you, if you bought it and it came back down through the T line into the body, which is very small, it doesn't matter whether it's the open or the close. If you want to be real specific, it opened at 52.51 and it closed at, I'm sorry, 92.51. So it had a price move of a range of 12 and the body is about 50 cents. So when you're looking at a doji, it doesn't matter whether you're talking about the open or the close. You're talking about that's where the indecision was. So if we want to be real specific, I wouldn't want to see it come back down through the close of today. But that statement doesn't really matter. But for those that would like to know if the body is a bit bigger than the open. Bill, is that a request after the double line? KAR looks like a kicker signal, J-hook pattern in progress. So SI could be bought or sold tomorrow, depending on where it opens. Exactly. What do we do as a doji rule? If you want to buy it and it starts opening positive and trading positive, it's a doji rule trading positive. If you had already bought it and it opens lower, you close it out immediately. EVLO, there's your left-right combo in the oversold area, followed by a doji sandwich. If this opened positive tomorrow, what would it be telling us? The doji sandwich implying more upside. If it comes up through the 50s, telling us the 50 is not acting as resistance. Where do you think the next likely target's going to be? Probably somewhere up in this range. There's your doji sandwich. No, I'm sorry. Your bullish flutter kicker signal. Bearish candle, gap up doji, opening positive, kind of breaking out through this level. This tells you there's a lot of strength because if you took out that little flutter, you essentially have a kicker signal. Peloton looks like it's bouncing back up. I would suspect it coming back up here, which would coincide with the 50-day moving average. The doji in the middle with long sticks both sides. Does it have any special significance, like a lot of indecision? BG, have you read high profit candlestick patterns? HSC, there's a J-hook pattern in progress. If this opens positive, what's it telling you? Wave 3 is about ready to start, same magnitude as this one. And KPTI, oops, I've kept this way past bedtime. There's your bullish engulfing, scoop type pattern, doji sandwich. Look for a slingshot effect to the upside. And VVNT, bullish engulfing, doji sandwich. Look for more upside. Not a bullish best friend, it's just more of a bullish flutter kicker signal. But it doesn't matter what you want to call it, it's still a very strong signal. Okay, so when you have, oh man, whose handwriting? I don't think this was the right one. BRIQ. No, that's just great when you can't read your own handwriting. That was to illustrate, oh, this right here. When they come up and they fail at the 50, give you a strong sell signal and you're kind of in a downtrend, that tells you you're probably going to have more downtrend with a higher degree of probability. So today, and I don't know why this isn't working, but I think the 50-day moving average was right here. But notice that this failed. And if you look at this overall chart, and I don't know why this isn't working, something's happened where the downtrend is in progress. There's a downward trend channel, and this one failed. If this opens lower, good prospect of this coming to this level and or down to this level. What is the purplish line? That's, I don't know. The black line is the, I think this must be the 34. But this chart, this, for some reason the moving averages are goofed up over on this chart. Kind of the same thing right here. A doji breakdown. Big move, wave 1, wave 2, looks like it's going into wave 3 to the downside. Ear, another perfect example of an evening star type signal, and you stay short on this one. Kind of the same scenario as the Daku chart. You stay short. The red line is the 200. The blue line is the 50. Simple. The T line is the black line, and the grayish line is the 34 EMA. Jake, this is not delayed. This is just delayed because of this service. But obviously, these are all closed, so I don't use this one to trade unless I'm trading the commodities, which I'll flip to real quick. Made some very good money today being short on wheat. It was down like 37 cents at one time. Closed it out as soon as it hit the 34. Corn was doing the same thing. It closed down the limit today. Now popped up a little bit, and soybeans was down at one time 63 cents, which is a huge move. On a normal day, it might move up or down 8, 10, 12 cents, but it was down 60 cents today. Cattle was down huge today. And look where it failed, right at the 50. Where do you think it's coming back to? The 200. And hogs, you can see how this was rolling over. You had your sell signal, you had your double doji, then it gapped down, made some good money short on this one, and we'll probably re-short it if it opens lower tomorrow. Gold, kind of hovering. Let's get better gold. Kind of hovering in here, still in a slow uptrend. Silver, bah. Silver backing off, but still in a steady uptrend. And so crude oil backed off some today, and I guess right now all the oils are selling off. This is Apache. This is Occidental. So these are all good sells or good shorts. Here's EOG. If this opens lower, you could be shorting this one. Notice what the reversal was. They gapped up in the overbought area, did a doji, and gapped back down. That's your abandoned baby, telling you there's been a strong reversal. So anytime you see a strong signal, like a kicker signal, that's telling you there's going to be more downside. And PDD, PDD was like that one. PLL, still in a downtrend. So right now with these market conditions, depending on where they open the NASDAQ tomorrow, will give you a good indication whether they're going to bounce at least back up to the T-line, or wave 1, wave 2, wave 3 probably coming down here to test this level. I heard that 70% of the gas stations were out of gas in one of the Carolinas. Yeah, I saw pictures, but I thought it was New York area where there was gas lines. And it's because of, I guess, that one pipeline that was having problems. Okay, so are there any general questions on candlestick analysis? Carrie, if you were stopped out of trades or they closed below the T line and you closed them out, you have to look at the chart and say, is this the best place to put my money, or are there better charts to now move to? Yeah, DDD had a kicker signal the other day, but then you can see that it didn't last. Now, this is one I would have looked up to see what caused that, meaning what caused the kicker signal. Jake, what do you want to know about trailing stops? I've only got one aspect of a trailing stop, that if you're in an uptrend, either use the T-line or the previous day's open when you get up to the overbought area. If you're asking whether I use any percentages, no. The price of the market doesn't give a hoot what percentage you want to think it shouldn't pull back. The market will tell you when the market has reversed by coming back down to a level that tells you investor sentiment has changed. Looking at the NASDAQ chart, when would you consider going long? Well, pretty much if this opens positive tomorrow, especially if they brought it back up through today's high, that would tell me they're bouncing it. Either use the fee line or tomorrow the last daoop. SD, you got me there. If you're holding Apple, I wouldn't sell it now if you've held on to it, but I wouldn't be buying it either until it gets back up through the 50 and the T line. Diane, yes, we started buying this one at 73 cents. Right here. And it went to the $17, $18 area. Well, now what happens, and this is, we're going to be doing a, let's see. We're going to be doing a free weekend on the 22nd, Saturday. And it's on how to take advantage of the big price moves. And so you're going to get some observations. After you've had a huge price move and the sellers come in, this is not an unusual situation. It goes flat for quite a while. It did a scoop pattern over here. We were buyers again. And then look what got us back out. There was your kicker signal. Now you've got a bearish J-hook pattern. However, after hours, it was trading back up. So you want to see if it's going to be supporting here at the 50-day moving average. Okay. Yeah, it's a little bit flat, but I wouldn't be afraid to be buying this one. CC, wait till I tell Rick to do the double line. So Rick, go ahead and do the double line. All right, now you can, and in 3.1 seconds, put in the next double line. Okay, I'll try to do this quick so that we're not here all night long. PRQR, telling you absolutely nothing. Here's that same phenomenon. Big, huge price move. The bears, bulls and bears came in. Now you're flat. I wouldn't be long or short this one. QFIN, if you're short, stay short. ARVL, you get ready to short this one on weakness tomorrow. NIO, stay short. Marathon, this one you can short on weakness. You can see how it's failed. NTP, you stay long. Now this would be a case where you're in the overbought area. I'd have my safety stop at today's open. Don't think it's going to come back through there. Looks like it's still heading up, but I put a safety stop here because if something happened and it came down through there, you should be out of that trade. LCI, Morningstar signal confirmed. You could buy this one on strength. Another one where I'd probably put my stop at the halfway point of this candle. Tell me that the bears weren't, or the bulls weren't in control anymore. Yes, first target would be the 50. METC kicker breakout. You can buy this one on strength. Nerve. You can buy this one on positive trading. This is kind of your message. And then they started trading in positive. So you were told to the profit taking. Now the profit taking's over. Devon, you probably want to short this one on weakness. Cliffs, short this one on weakness. That'd give you a bearish doji sandwich after your dark cloud and your can't tell whether that's a bearish engulfing signal or not. BGFV, there was your shooting star. There's your hanging man. There's your confirmation. I'd short this one if it came down through today's low and the T line. Fry pan bottom breakout. No, this looks more like a mini scoop pattern. You could also give it kind of a fry pan bottom, but it's a good pattern that tells you they've broken out. You can now you just watch. You're getting up toward the overbought area. Here's another one that if I was long, I'd keep a safety stop at a level that told me it shouldn't come back through or the bears are now taking control. FAS, nothing great. You need more confirmation. FedEx, need more confirmation. That's not a signal today. That's just an update so far. 3D, I don't know whether I would short it. I probably wouldn't be long or short this one. There's not enough direction to it to want to go either way. eBay, you could short on weakness, especially if it came down through today's low. CrowdStrike, you can stay short. I'd use the T line as your stop. Tech, stay short. JP Morgan, and you can stay long. Not a very exciting stop. It's not really a J hook. Nah, it's just telling you it's staying above the T line. FSR, stay short. Codex, stay short. Jazz, that's a little J hook type pattern. You can stay long on this one. You could enter it, yes. If you were buying on positive trading, you wouldn't want to see it close back below the halfway point of this candle, because that would tell you the J hook pattern did not break out. Would appreciate a day trade look back on fast mover IHT. Fast mover as far as what? Today, it opened up here. Apparently traded up. When it came back down through the open, you can see what was happening. You got the tails to the upside. I would have probably stopped out today at this level. So if you went to your 10-minute chart, looked like they took it up. And as soon as they brought it back down through this level, that's when you start closing it out. Wells Fargo. You can stay long as it stays above the T line, just not an exciting trader. No, I wouldn't buy it. Just not anything that's going to tell you that you're going to be anything more than a slow drifting uptrend, which will also be affected by the market. So even though it's an uptrend, yeah, unless you're thinking of buying it and holding it long term, because you like it for some reason, I'd be someplace else. Now that's a J-hook pattern. Notice what started this move. There's your kicker signal. There's your J-hook pattern. FedEx, not a J-hook pattern because it doesn't have the same confirming indicators. TBK, if you're short, stay short. Getting toward the oversold area, I would still use the T line as a stop. And CNO, is this considered a slow curve? No. No, that's just a slow, steady uptrend. AMC did some profit taking today, but if it opens positive tomorrow, you can still be buying it because it's broken out of that double bottom. Blink, I guess the question, Lee, is this the best place to be shorting a stock after it's moved down 30%? It's in the oversold area. When you ask that question, you should be asking yourself, where should I have shorted this one? Well, now you get more acclimated to see when the selling started. That's where you would have been shorting it. That's why we're putting out recommendations like this to say, well, they haven't sold this one off. It's got a little wedge breakdown. I think the 50-day moving average is right there. I don't know why it's not on this chart. Let's see what happens on this chart. Yeah, the 50-day moving average is right there. So I don't know why and you can see they're in a downtrend. HLIO, kind of a fry pan bottom with a belt hold. That belt hold told you they took out some more of the sellers. You stay long on this one. Crude oil backed off. You saw that on the regular crude oil chart. That's a nothing chart. I wouldn't be long or short. Not going anywhere. And Roku, another nothing chart. That's just very unexciting. And Mavis, stay short. Where did the short start? With that big selling. It wasn't quite a dark cloud. It wasn't quite a bearish engulfing. But look how far away it was from the T line. And then you've never had any confirmation, buying confirmation after that. TPTC, nothing. FGEN, you could buy this one on positive trading. It's got to break through this little resistance level. FTEK, nothing there either just yet. You notice that they opened it and traded it lower after the open. I need to see more bullish confirmation to even want to go long on that one. Boeing, you stay short. AMAT, I think you stay short. Whoops, it gapped up today. So if you had been short, I would have covered the short when they gapped it up and closed it above today or yesterday's open. Nothing wildly exciting on this chart, not until it breaks out through this level. I'd be someplace else. And Ruby, nothing major here. You could be going short on a lower open, which would tell you got a bearish doji sandwich, and they didn't support at the 50. Did coin report? today, depending on where it is after hours. Yeah, that one I would stay short if I was short. And Sid sold off. There's your bearish belt hold. There was your close below the T line. You could still short this one on a lower open because you'd have a bearish doji sandwich, which would tell you they're breaking through this level. Ah. That's kind of junky. Yeah, if it opens lower and started trading lower, you could short it. BTC, that one's not coming up. KYMR didn't execute today. It opened and then started trading right off. You got a J hook. I wouldn't be buying this one until it comes back up through the day's open. LRCX, another one that if I'd been short, I would have covered it. And now I wouldn't be long or short. Met, kind of the same thing. If you're short, it has to open lower and trade lower tomorrow. And PLTR, you stay short on this one. Use the T line as your stop. Okay, we've kept you way past your bedtime. Do you have specific recommendations, trades to take for your subscribers? Yes, every, in the members area, I put out 2 or 3 stock picks every night on a video or a 2-minute video. Not so you have stock picks, but you can also see what the rationale or what the signals were that created that recommendation. CRC, that's a good chart. There's your fry pan bottom, J hook, kind of with a bullish flutter kicker type signal. Okay, everybody. So GameStop, it was trading positive today, but not anything that I would want to go after just right now because it's sideways. Sarah, yes, we will be doing a free guest pass starting on the 17th. Becky, do we have any information on that yet? We're going to be doing a free guest pass for a week, or maybe it's 2 weeks. And then we're also going to be doing a free session on Saturday the 22nd. That gives people a good opportunity to come in and see what the rationale or the logic is that creates such high probability trade setups. Okay, Becky put in the link for the free week of trial. Not yet. This is just kind of a hint that we're going to have it. Right now, I think Abraham's in Disney World, so we'll get all that promo information out next week. All right, everybody, have a good evening. We will see you bright and early in the chat rooms tomorrow. We'll see you then.